Sullivan Cromwell is one of the premier law firms in New York City, and with me is Frank Aquila, a senior M&A partner at Sullivan Cromwell, and really enjoyed our conversation last time. Learned so much. So talk about what you're seeing in terms of the defining forces shaping M&A last year, and then also what seemed to matter the most in your practice.
Well, so last year, I think, was a bit of a tale of two cities. It was tale of two cities in my mind in two ways. One was, if we were sitting here last January, I would have said, we're going to have a roaring start to the year. It's going to be a very busy M&A year. And in reality, with the new administration coming in and some of the new policies, there really was a bit of a pause in M&A. And then the second half came on tremendously strong. It really was one of the busiest 6 months in M&A that we've ever seen. It was tale of two cities in another way, in that typically when you have these big M&A years like 2021, which was the biggest year for M&A, you saw deals of all sizes happening. And we didn't see that last year. What we saw were the megadeals. When I say megadeals, some people define them as $5 billion or more. Some people define them as $10 billion or more. But we didn't see the smaller and middle market deals. We saw only the large deals, by and large, the large deals happening. And I think that was because when the determination sort of was made over the summer that M&A was coming back, the deals that moved forward were the ones that had the most strategic importance to them. And so I think those were the defining factors for 2025. And I think, that's what we're going to see here in 2026.
Okay. You think more of the same. And how would you characterize the buyer-seller behavior?
Right. Well, one of the things that was actually helpful about the bit of a pause in M&A in the first half is it made sellers realistic about pricing. And I think when you go into a year like we did last year, where everybody thinks there's going to be a tremendous amount of activity, everybody looks at their stock price and says, I'm entitled to a 40% premium. When your stock price falls back a little bit and you start seeing deals being done with 20, 25% premiums, and if the stock is trading at an all-time high, a 20 or 25% premium is actually quite good. And so it made sellers realistic about pricing. It also made buyers focus on not just price and near-term value, but why this transaction was important to them from a strategic standpoint. How this was going to be a game changer, not just for them, but for their industry, or the changes that were happening in their industry made them do these transactions.
So you mentioned large deals tended to dominate. Were there any particular industries that you saw a lot of activity in?
So, tech, we've seen obviously entertainment be important. Healthcare and life sciences, they seem to be, that's an active sector every year, even when M&A is off. Those tend to be very active deals. What we saw last year was a lot of banking and financial institution transactions, which we really hadn't seen a lot of since the financial crisis. And I think the driver in the financial institution sector is also a driver in M&A overall, and that is AI and AI capability. And the financial institutions have to invest a lot of money into AI, as do a lot of other industries. And if you're a small regional bank, you don't necessarily have the capital that some of the big money center banks have. And so it makes sense to consolidate among regional banks, and it makes sense for bigger banks to be buying smaller banks. And we're seeing that really in a lot of industries.
Now, what would you say determined deal certainty last year? And what do you mean by that exactly, deal certainty?
So one of the things that I have to do in advising companies and advising boards that are the sellers in transactions is you have multiple bids. One bidder, though, is offering you a dollar a share more, but their funding isn't as solid. They may not get regulatory approval. There may be other issues. So when I look at deal certainty, I want to know that the cash is there to do the deal. They have solid financing. They have backup if one of their financing sources goes out. They, if they need shareholder approval, that's not going to be an issue. And most importantly, that they're going to get regulatory approval.
So this reminds me a lot of the Warner Brothers Discovery, Paramount, Netflix situation.
Yes.
Do you have any thoughts about that? Or?
Well, I think in situations like that, boards really have to have good counsel. And when I say counsel, I don't mean just lawyers, financial advisors, people who are industry experts, telling them what's the potential. Is the stock that you're getting in the transaction as valuable as the cash you may get? If you're doing a spinoff, what's that spinoff really going to trade at? So, it's one of those situations where you don't just bring it into the board and say, you got this great deal, 50% premium, all cash, they can close in 30 days. You're really having to educate the board. And sometimes you're educating the board in topics that they might not, they're all very, very smart people, but they may not have had a lot of experience in. And so you need to go through each of the factors very, very carefully and slowly. I mean, I've had transactions like that where literally you're having full-blown board meetings, 2 or 3 times a week for a couple of weeks because there is so much material that has to be covered.
Okay. Yeah, and you just have to kind of bring everybody up to speed on all the intricacies of the deal. Now, how did deal structures evolve last year to bridge gaps? What does that signal for 26?
So one of the things that you find is that sometimes there's a disconnect between what the buyer is prepared to pay and what the seller thinks that their company is worth. And we've seen this a lot in healthcare transactions, particularly biopharma transactions, the use of a contingent value right, which basically says if these things happen over the course of the next 2 to 3 years, we will pay out to the shareholders an additional $3 a share, $5 a share, $10 a share. And that way, you're certain that if the business goes as the seller thinks it's going to go, that you're going to get that extra value. But if not, the buyer is not overpaying. That, to me, is the biggest thing you're seeing in public company deals. You can do a lot of things in private deals, obviously, but in public company deals, contingent value rights is an area to look at. And I think we're going to see more as deals become pricier, as there's less certainty, particularly, say, like in the AI sector where you're buying AI capabilities that are really nascent at this point. And so, having contingent value rights or other mechanisms like that are going to be very helpful to getting deals across the finish line.
What role is AI or technology in general playing in terms of the deals that are getting done and how they're getting done?
So AI really is having a pervasive effect on M&A in 2 ways. One, it's driving deals. As I mentioned, in the financial services sector and other sectors, companies need this AI capability, or they need access to the AI capability. And that's where the acquisitions come in. Sometimes, they're called sort of acqui-hire deals, where you're making acquisitions basically because you want the personnel that they have. They have 50 people who are working together, who have the resume, the capabilities, and rather than going out and trying to assemble this team, you're in effect buying a team. So you're seeing deals like that. You're seeing deals that companies are using in order to source their deals. They use the AI technology. The initial due diligence is done by AI. So AI really is having a profound effect on M&A.
Yeah. And then what would you say separates acquisitions that actually create value versus what kind of creates a lot of hype and excitement on the announcement day?
Well, to some extent, you never know for a couple of years. But what really is important is that the deal is being done for strategic reasons as opposed to just financial engineering.
Okay.
I mean, if you're trying to get a pop in your stock price now, that's great. And there are a lot of deals done on that basis for a good reason. But if you're really trying to put together the XYZ company of 2030, and that's what your strategic goal is, those are the deals that tend to create value. And buyers who do that tend to be prepared in terms of day one integration. And that's where deals fail, is where the buyer is focused on getting the deal done, but not focused on how they're going to implement the deal.
Okay. Interesting. Now, we're in 2026. Are you seeing a continuation of these trends? Or what kind of things do you think will impact M&A activity this year?
Right. To some extent, there's always a break at the end of the year because people go on holiday or whatever. But the thing that I saw this year was phone calls and Zooms throughout the holiday. And, people aren't coming into 2026 saying, well, it's a new year. We need to think about new things and whatever. People really are focused on the same things in January that they were in October, November, and December. So I really think, at least for the first half, we're going to see very much a continuation of what we saw at the end of 2025.
And what kind of things should executives keep an eye on in terms of, I guess, macroeconomic? We've got another election this year.
They should also be looking at geopolitics. Obviously the events in Venezuela are a reminder that, whether positive or negative, that geopolitics influences business. They should be looking at shoring up their funding sources. And the last thing that I think executives need to do, and most of the good ones do that, is keep your board informed about your thinking. Don't just come in with the grand plan after working on it with your team for 6 months. Keep your board informed along the way, get their input, and that way, when you actually say, okay, here's the acquisition that we're going to do, here's the series of transactions we're going to do, the board is fully up to speed. The board is supportive, not just of the particular transaction, but of the overall strategy.
And then what can boards and executives do to make sure they're deal ready when an opportunity arises?
Making sure, as I say, that their financing sources are lined up, and that's relationships with financial institutions, private credit in many cases. Secondly is understanding the regulatory risks and knowing if they need to talk to regulators before they announce their transaction. And go back to the point I was making sure that they're ready to implement any deal that they do on day one.
Okay. Frank, always fascinating. Thank you so
Great
much
to see you.
for sharing your insight.
Thank you.
Thanks.